Hello everyone. Today I wanted to run through the IRS Form 926. It's a return by a U.S. Transferor of Property to a foreign corporation. So I wanted to kind of dive in on this form because this is probably one of these forms that I see that is most often missed. Even in cases where it's plainly obvious that this should be completed. And it's funny because I think I've seen a lot of tax software programs over the years, and a lot of them don't even include this form, and it kind of runs in tandem with the 5471 filing for U.S. persons. So I think the most common instance where this would be required, and it's often missed, is you have a U.S. person that becomes a shareholder in or forms a foreign corporation, and it's a CFC, let's say. So it's a U.S. person that now has to file a Form 5471 initial year, but this form should be filed as well. This is designed to report the amount of cash or property that was transferred by that U.S. person to the foreign corporation in exchange for stock. So if you ever see a scenario where you've got a U.S. taxpayer and they're filing a initial 5471 with their return, because they just set up a foreign corp, you're very likely going to need this form as well. I mean, there are cases where, if they have a nominal shareholder interest, maybe they won't need it, but we'll go into the examples, a couple examples as to why this would definitely be necessary. So I just kind of want to run through the form, cover all the fields that you might have to complete, others that you can probably pass over because they're for really unique circumstances, and then we'll just talk about why you really want to get this form filed because of the potential penalties for missing it. So the first part here is relatively straightforward. I mean, the name of the transferor, so that's the person that is sending the cash or property abroad in exchange for the stock. Now this person, so this is generally a U.S. individual or a U.S. corporation or a U.S. S corporation. The 926 form is not filed with a partnership. So if you have an example where you've got a Delaware limited partnership or a Delaware LLC that's taxed as a partnership, and you've got a bunch of investors that put money into that Delaware entity, and then that money eventually flows down to a U.S. or not a U.S., a foreign corporation. That is the U.S. transfer of the cash, right, constructively or at least directly. But the partnership doesn't do the reporting. The partnership basically footnotes a lot of this information, and so it's included in a footnote to the K-1, and the amounts and the percentages are in effect allocated across all of the partners in that partnership. So you won't see a 926 form filed with a Form 1065 partnership return. It's the ultimate beneficial owners, the partners on the other side, that might have to file this. So that's really, really important to highlight, because if you file a 926 with a partnership, that's not enough. You really have to pass on all the information to the ultimate owners, and those are the ones that need to be perhaps filing this form if they meet the requirements. So just using myself as an example here, you would put your name or the corporate entity name, and then the tax ID number. So if it's an individual, it's a social security number. If it's a corporate entity, you've got the EIN. So question number one, is a transferee a specified 10% owned foreign corp that is not a CFC? So in this example, it is a CFC. I'm going to create a fact pattern here where I transfer cash in exchange for stock, and I own 100% of the company. So if I'm a U.S. person and I own 100% of a foreign corp, I'm a U.S. shareholder under the code, and this is a foreign corporation that's greater than 50% owned by U.S. persons. So it is going to be a CFC. So I'm going to check no here. Okay, so we'll scroll down a bit. This section, let's see. So this section is relatively new. If the transferor was a partner in a partnership, but that was the actual transferor, but is not treated as such under 367, complete this information. So this is highlighting kind of what I noted, a minute ago, is if you are filing this because you were a partner in a partnership that directly contributed the cash in exchange for stock, you would enter this information here. So if I was an investor in a Delaware limited partnership that was a PE fund or something like that, I would still be completing this form and attaching it to my 1040, but I would enter the partnership information down here, right? I made the contribution via a Delaware limited partnership, and so I put the name of the partnership and the EIN of the partnership. So Transferee Foreign Corp, this is the foreign corporate information, right? So in this example, I'm using, okay, I transferred cash to a Cayman Islands LTD that I set up. So I called my lawyer and I said I wanted a Cayman Islands corporation, so we set this thing up. So you've got information on the corporate entity here, the name, the address, country code, its characterization under foreign law. So an LTD is generally a corporate entity under foreign law. If it was a Cayman Islands LP, it'd be a limited partnership. And then again, question 9, is the entity a CFC? Yes, because when we get down to the rest of the fields, you'll see that I've entered that I'm going to own 100% of this thing. The ID number up here, you don't, most foreign entities don't necessarily need a U.S. EIN, so they don't need a U.S. tax ID number. So the common placeholder in this circumstance, whether it's a foreign entity or a foreign individual that doesn't have a U.S. tax ID number, you just put foreign U.S. That's kind of the standard entry that is accepted by the IRS's e-file system. So if you put in any kind of random number here, it's probably going to get rejected. So in a case where you have a foreign entity or a foreign person, if you enter foreign U.S., the IRS's e-file system will accept that, and that the system will understand that this is a foreign entity, and so that's the appropriate entry if it doesn't have a U.S. tax ID number. Okay, so part 3. Again, in this scenario, we're saying we're just transferring cash. There's a lot of other sections down here if you're transferring property, or it gets certainly a little more complicated, especially in the intangible property section. And that does happen often for larger companies. There might be a situation where they have intellectual property held in a domestic entity, and for certain reasons, transfer pricing reasons or whatever, asset protection, liability protection, they might set up a subsidiary overseas, and they will take that IP and push that down to the sub. And so the IP being transferred to the sub in exchange for stock is what would have to be reported on this form. But in this example, I'm just going to keep it pretty straightforward, and we're just transferring cash. So type of property, cash, they've already got it hard-coded in there, right? So I'm transferring cash. You enter the date that you transferred it down there. So, this is generally the date of formation. And it can be, you can usually lump sum figure, right? So if you spend $1,000 on, legal fees, incorporation fees down there, and then you open an account and you put $200 in, it's okay to throw it all in one and just indicate the date of transfer and the fair market value of the full amount of cash that you would have incurred just to get this thing launched and off the ground. Now, after the formation, if you continue to send down more money, right? So if a couple months later you've got the account open and you funded it with more cash, right? Then you would need to continue to, you would have to update this figure accordingly. So. Okay, so let's see. Which cash only property transfer? Again, we're going to say yes. I didn't transfer any intellectual property. I didn't transfer any, tangible assets, nothing like that down into the company. So I can skip these sections here. Okay. Okay, and so part 4, additional information regarding the transfer, right? And so in this scenario, like I said, I'm going to we're assuming that I'm this is a solely owned corp, right? So I own 100% of the stock as a transfer. So before and after, and then the type of non-recognition transaction. So Section 351 is broadly saying that if you U.S. taxpayer transfer cash to a corporate entity in exchange solely in exchange for stock, and you control the entity afterwards, it's a non-recognition transaction. So there's no gain or loss that has to be recorded for either the taxpayer, so the individual, myself in this case, or the corporate entity. And so it's referred to as a Section 351 exchange. And so again, the other questions here is, so let's say perhaps this wasn't a 351 exchange. There was some sort of gain recognition on one of these sections. You'd have to enter yes, and perhaps update your return or the filings for the corporate entity to recognize any gain if necessary. Okay, so that's again, this is a very simple example, cash in exchange for stock, where you own 100% of it, so there's not too much going on here. I'll do a separate video on some more unique circumstances where you might have some of these issues where you're transferring IP, or you might have some gain recognition, or perhaps it's an indirect contribution through a partnership. Because again, you definitely see that a lot in a private equity or a hedge fund context, where a U.S. person is investing through a fund, and that fund directly holds interests in foreign corporate entities or foreign limited partnerships, and so you'll get a lot of this information on your K1 footnotes. And of course, there's substantial disclosures in those footnotes where the fund is saying, look, here's all the information. You have to figure out whether or not you're going to have to file a 926, so talk to your tax advisor, right? And so at that point, if you see anything like that, you definitely want to talk to your tax advisor just to make sure that you're doing everything correctly, because the IRS does impose penalties for missing these forms. Right now, I think it's quite nominal relative to some of the other filings. So I think it's 10% of whatever the F&V is of the property transferred. So if I send $1,000 down, I could be penalized $100 for missing this. So it's not too terrible, but I guess it's not as egregious as just flat out missing the 5471, right? So if this is clearly a CFC, so in addition to this form, I'd have to file a 5471. If you miss a 5471 filing, even if there's no activity and you made no money through the corporate entity in the Caymans, you're looking at a $25,000 penalty, right? It used to be 10 grand a pop, and the IRS is kind of ticked off that people are not disclosing all of these offshore holdings adequately, so they've increased the penalty from $10,000 to $25,000 per form. So really, really important, if you've got any kind of foreign financial assets or holdings, make sure you're getting your 5471s done, your 8621s if it's a PFIC, and then of course this form as well, a 926 if you're transferring cash or property abroad in exchange for stock in a foreign entity. So that covers everything I wanted to address today. If you guys have any questions, feel free to email me, leave a comment on the video. Happy to respond that way. And please, like and subscribe to my channel. And I look forward to seeing you guys again. Thanks.